tariffs are actually, we've had a lot of experience with them. They're an act of war to some degree.
How do you think tariffs will impact inflation?
Over time, they're a tax on goods. I mean, the tooth fairy doesn't pay them.
The U.S. stock market has fallen into correction territory, and Warren Buffett is warning that this could just be the beginning. Buffett broke his silence and had harsh words for what lies ahead for the economy and stock market. For the first time in years, Buffett gave a publicly available interview. He used this interview to give a warning about the potentially devastating impacts of tariffs and how this could lead to a full-out economic war. Take a listen to what Buffett had to say.
Can I just ask you a couple of questions about kind of how you see the state of the economy right now?
Well, I think that's the most interesting subject in the world, but I can't talk about it now. I really can't.
How do you think tariffs will affect the economy?
I mean, tariffs are actually, we've had a lot of experience with them. They're an act of war to some degree.
How do you think tariffs will impact inflation?
Over time, they're a tax on goods. I mean, the tooth fairy doesn't pay them. I mean, and see, you always have to just, and then what? You always have to ask that question in economics. Always say, and then what?
So is there an answer for that when people say, inflation persists, consumer prices keep going up, when's the end in sight?
No, prices will be higher 10 years from now and 20 years from now and 30 years from now.
And what do you think about what's happening in Washington right now? About efforts to cut
I think it's Washington.
Yeah.
It's, technology changes things, all kinds of things, but Washington is Washington. And the problem with politics is that you tend to have to make tiny compromises as you go along.
If 2022 was the year of inflation and 2023 and 2024 were the years of artificial intelligence, it appears that tariffs are going to be the new buzzword of 2025. Internet search traffic for the word tariffs has spiked recently. For a word that has gotten thrown around so much, very few people really know what tariffs are and how they function. So just how exactly do tariffs work? Well, a tariff is simply a tax applied to a country's imports. Imports being things brought into the country that were manufactured elsewhere. To demonstrate how this works in action, let's use the United States and Mexico as the trading partners and the example of a car. The U.S. auto industry is an extremely competitive industry. Auto manufacturers have average profit margins of just 3 to 5% over the long term. So put another way, for every $100 in sales an auto company has, only $3 to $5 of that turns into profit. A big driver of this is that the industry is notoriously price competitive. Understandably, consumers want the best possible vehicle at the lowest possible price. As a result, a significant part of the auto supply chain is outside the United States. This dynamic has led the auto industry to be front and center in the tariff discussion. For this example, let's just say it costs the car manufacturer $30,000 to build a car in the United States, but only $25,000 to build that same vehicle in Mexico. In order to be more profitable and cost competitive relative to competitors, a U.S. automaker may look to produce a portion of their vehicles in a lower cost country, such as Mexico. Here's how that looks without tariffs. The U.S. automaker will be headquartered in the United States, but have a manufacturing plant in Mexico. A vehicle will be manufactured in that plant in Mexico and then shipped to the U.S., where it would be sold to the end consumer. With no tariffs in place, the cost of that vehicle for the U.S. automaker will be just the cost to build it in Mexico plus the cost of transporting it to the U.S. to be sold. When a customer goes to a car dealership to buy a car, the car company that builds its vehicles in Mexico will be able to sell those vehicles for less than its competitors that build the vehicles in the U.S. In an extremely cost-competitive industry like cars, this is a huge advantage for the lower-cost manufacturer. Here are how tariffs change things. Let's say a 25% tariff is put in place by the United States on Mexico. The car that is manufactured in Mexico still costs $25,000 to build in Mexico. However, as it comes into the United States to be sold, a 25% tax is applied to the cost. That works out to an additional $6,250 that gets added to the cost of the vehicle. With this 25% tariff in place, it now costs $31,250 to build a car in Mexico and sell it in the United States due to the tariff. Notice how this $31,250 amount is now more than what it costs a car company to build a vehicle in the U.S. This is the goal with tariffs: to make U.S. manufactured goods cost competitive relative to those manufactured internationally. The thought being that if tariffs increase the cost of internationally manufactured goods, more U.S. manufactured goods will be purchased. If this happens, what is known as the trade deficit will start to close. A trade deficit occurs when a country imports more goods and services than it exports over a certain period. This means that the value of what a country buys from other nations exceeds the value of what it sells to them. The current trade deficit for the United States hit a staggering $918 billion in 2024. This means that the U.S. bought $918 billion more worth of goods and services than what the country sold to other nations. As you can see here, back in 1995, this trade deficit was only approximately $100 billion. This ballooning trade deficit is cause for concern according to Warren Buffett. Listen to what he had to say when asked about the U.S. trade deficit back in 2018.
I think it was in 2003, Joe, I wrote an article for Fortune actually about the trade deficit. I was worried about it getting too large then because, again, it was getting to be 3% or so of GDP. And it wasn't specific to China at all, but it was just a question of how wise it is to let the trade deficit grow larger and larger, because when you run when you are in effect buying more from other countries than they're buying from you, you are handing them investment funds. I mean, it's the nature. You give them little pieces of paper and they can convert that into buying. They can buy government bonds. They can buy buildings here. And Japanese bought Pebble Beach in the 1980s when they were running a big surplus. I mean, so you are giving up claim checks on our country, essentially, in exchange for having more consumption now than you're producing in this country. And so I do think that there's levels of trade deficit that bother me. I had some system that did not make it country specific. But I think the world has gotten better and better, and there's no question that countries may try and take advantage in this or that. And we've actually been guilty of that sometimes in the past, too. I don't think leaders in other countries, whether China or 100 other countries, are not smart enough to realize that it's in the interest to keep promoting trade. The more we trade over time, and we don't want it to be a question of where we import 20% of our GDP and we export nothing. Now, we could all quit working, and we could hand little pieces of paper to the rest of the world, and they could keep sending us food, and they could send us autos, and they can send us all kinds of things. But eventually they have claims on all our wealth. So we do want to have policies where the overall trade deficit does not get out of hand in relation to GDP. And I've been arguing that for a long time.
This large trade deficit is causing two significant problems for the United States. One of the most significant negative impacts from large trade deficits is job losses in domestic industries. When a country imports more than it exports, domestic manufacturers struggle to compete with cheaper foreign goods. Let's go back to our example of the U.S. car-based manufacturer. Imagine that this car manufacturer has 10 plants located throughout the United States. The company makes the decision to move half of its manufacturing to locations outside the U.S. This means that 5 of those 10 plants will get closed. The workers in those 5 closed factories no longer have a job at that company. While this U.S. automaker example is obviously hypothetical, this trend has played out in real life. The U.S. domestic manufacturing base has shrunk to a fraction of its former size. In 1979, the number of U.S. workers employed in manufacturing peaked at nearly 20 million. However, that number has since fallen to 12 million in 2025. A 40% reduction in the number of U.S. workers employed in manufacturing, despite the U.S. population growing significantly during that time period. In the 1950s and 60s, approximately 30% of all U.S. jobs were in manufacturing. That number has been on a steady decline over the last 70 years and is now in the single digits. The shuttering of factories across the country has led to many cities in the United States becoming shells of their former selves. Detroit, Michigan is the poster child for the devastating impacts from loss of domestic manufacturing jobs. In 1950, Detroit was the 5th largest city in the U.S. with a population of 1.85 million. Detroit was a boomtown due in large part to the success of the U.S. auto industry. At this time, automakers in Detroit had over 85% market share of the U.S. auto industry. Peoples and families were flocking to the city in droves for the well-paying manufacturing jobs available in the area. The population had increased by 7 times over the prior 50 years, well outpacing the growth rate of the rest of the country. In fact, in 1950, Detroit had more millionaires than any other city, even more than the financial hubs of New York and Chicago. However, this prosperity was not permanent, and the 1950s marked a peak for Detroit. the Detroit automakers started to lose market share to foreign competitors, ultimately leading to the bankruptcy of 2 of the big 3 Detroit automakers in 2009. The struggles of the U.S. domestic auto manufacturers had a devastating impact on the city of Detroit. As you can see here, the population of Detroit fell from a peak of 1.85 million in 1950 to just around 600,000 as of the making of this video. The city of Detroit is a testament to the devastating impacts of domestic manufacturing job losses can have to a city and community. According to Buffett, the second problem with large trade deficits is foreign ownership of assets. In the earlier video clip, Warren Buffett described the United States having a large trade deficit as giving another country claim checks. What he means is that when the U.S. imports more than it exports, it effectively is giving away portions of the country's future economic output in exchange for goods today. These claim checks represent foreign ownership of assets and debt. While that may sound complicated, it actually is pretty simple. Here's how that works. On this side, you have the United States. Over here, you have an imaginary country by the name of Investor Land. In this example, Investor Land is a tiny country known for producing the very best luxury watches in the entire world. These watches have become the ultimate status symbol and can't be bought from any country besides Investor Land. Let's say over the course of the year, U.S. consumers buy $5 billion worth of fine luxury watches from Investor Land. Investor Land sends the watches to the United States and gets back in exchange $5 billion US. Pay attention to the fact that this money is in U.S. currency and not the currency of Investor Land. You'll see why that matters in a second. For simplicity, let's say Investor Land doesn't purchase any goods or services from the United States. Because of this, the U.S. has a trade deficit of $5 billion with Investor Land. The U.S. imported $5 billion worth of luxury watches from Investor Land. However, Investor Land spent $0 purchasing U.S. goods and services. At the end of the year, Investor Land is holding $5 billion US. Investor Land can't use these US dollars in their own economy as Investor Land has its own currency. Investor Land is not going to just let those $5 billion US sit in a bank account unused. Instead, those US dollars are going to be put to work buying US assets such as stocks, bonds, real estate, and businesses. These investments act as claim checks on the future wealth of the U.S. that Buffett referenced. The U.S. must eventually pay interest, dividends, and profits on those assets to Investor Land. You can see how it could be problematic for the U.S. to run a significant trade deficit with Investor Land year in and year out. Each year, Investor Land can use the U.S. dollars it receives from selling the luxury watches to the U.S. to buy more U.S. assets. Put another way, with each passing year, the country of Investor Land is owning a larger and larger piece of the future production of the U.S. This dynamic is why many U.S. politicians are pushing strongly for the United States to implement tariffs with countries for which there is a significant trade deficit. However, as the old saying in economics goes, there is no such thing as a free lunch. One of the potential repercussions from tariffs is higher inflation. Tariffs increase the cost of imported goods, which means consumers pay more for products they would otherwise get at a lower price. Additionally, tariffs lead to elevated uncertainty. Businesses struggle to plan for the future, leading to lower investment in expansion, hiring, and innovation. Only time will tell how things ultimately play out, and the stock market will likely continue to remain extremely volatile. However, as Warren Buffett likes to say, never bet against America.
I've always been bullish on American companies.
Majority of any money I manage will always be in the United States.
And why is that?
It's the best place.
If you enjoyed this video, make sure to check out Warren Buffett, How to Invest Small Sums of Money, because with 500,000 views, people are finding it incredibly helpful. In the video, Buffett talks about how to go about generating 50% annual returns with small sums of money. I will see you over there.